Hello and welcome to Nothing Ventured with me, Aarish Shah. Today in the studio with me, I had Varun Rekhi. Varun is an EMEA-focused growth investor at Speed Invest, a leading European venture capital fund with over 1.2 billion euros AUM. Varun specializes in scaling ambitious, product-led tech companies across Europe, the Middle East, and Africa, investing at Series B and beyond. With roots in India, professional foundations in US IPOs at PwC in New York, and his current base in London, Varun brings a uniquely global perspective to venture investing. From his first EMEA deal in Kenya to his recent growth stage investments across Germany and beyond, Varun's approach combines rigorous macroeconomic insights with hands-on operational experience. He's passionate about fintech, SaaS, and the strategic nuances that differentiate successful investments across regions. In today's episode, we talk about why Europe's flywheel is broken and how to fix it, how Europe doesn't have an input problem, it has an output problem, and why it needs a roaring 20s mentality.
For lack of a better phrase, it's like Europe needs a bit of that roaring 20s mentality, which was there in the US, and just to celebrate success and wealth like that.
We talk about the fact that the sleepy capital allocators are waking up to Europe and how early stage is about the 4 T's, team, TAM, timing and traction, but growth is all about commercial, financial and legal.
You cut up diligence into 3 areas, commercial, financial, legal, right?
How you should start a business to have pain, preference or passion, and why we're moving into a world where we need to create more creative exit strategies.
We've started like a DPI team for sort of creative exit strategies.
Why in your youth you should throw yourself into messy real-world environments to build first principles thinking.
You need to throw yourself in sort of messy real-world environments to be able to develop first principles thinking.
And how you should find your place on the EQ, IQ scale.
But the more early you are, you kind of have to reduce the IQ scale and really understand EQ first.
Let's get straight into it. Hey guys, whilst I've got you for a second, I thought I'd reintroduce myself. My name's Aarish. I'm the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy providing fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you like the podcast, we would really appreciate it if you could subscribe, rate, and like wherever you listen. And of course, if you want to get in touch about anything to do with the podcast or Emerge One for that matter, do reach out to me on LinkedIn or Twitter. I'm always willing to have a conversation. Right, let's get back into it. Varun, really great to have you in the studio with me today. Thank you so much for joining.
Pleasure's all mine. It was just a small trek up north.
Yeah, no, and this has been a long time in the making as well. But look, we're going to dive straight in. I want to bring a bit of a macro context to venture, because you and I have talked a fair amount of that, right? About that. So Europe's venture ecosystem, like, very often feels like it's operating in Silicon Valley or the Bay Area's shadow, right? Especially with Europe's biggest capital allocators investing in US funds, right? And we all somewhat understand, the problems that leads to in terms of growth capital in the UK and Europe and more broadly. So why do you think Europe's VC flywheel is broken? And where do you think its real competitive advantages lie, right? You've worked in IPO advisory at PwC in New York, investment banking at JPM in Singapore, and now growth stage VC in Europe. So can you contextualize kind of venture from the macroeconomic perspective, especially given, the current turbulence that we've seen, which seems to be growing day by day? So I guess sort of those two questions: why is Europe's flywheel broken? And then secondly, the macro perspective.
Yeah, it's pretty interesting, right? Because I keep thinking we all live in a LinkedIn echo chamber, right? But realistically, when you go down to macro fundamentals, right, I think the flywheel is broken not because of an input problem, it's sort of an output problem, right? And I know we talk about this, right? Liquidity, et cetera, but the output problem is what causes that flywheel to sort of not work, right? There's a sort of breakout in that flywheel. And let me explain that a bit more. I think we're all aware that the depth of capital markets globally, US versus Europe versus China versus India, I mean, it's a no-brainer, right? But I think it's important to understand that outside of us blaming capital markets and sort of the regulatory structure, why the London Stock Exchange or the DAX or so on and so forth, why it doesn't work, I think it's a question of overall mindset that exists amongst the retail investment community.
Yeah, 100%.
Right? So I think you
will public market investors.
Just public market investors. And I saw this in a very small anecdote when I was in Saudi, and I was speaking to a friend and I'm like, hey, what are you doing? And he's like, look, I'm actually buying into a $200 million alternative investment opportunity with my phone. I'm like, that does not sound right. And he's like, no, I'm actually doing it. I'm like, are you accredited? He's like, no, but we can buy that here. And then I looked into the stats. Even in Tadawul, there's at least, as per the last stats, 90% of trading volume is retail investors.
That's crazy.
And Tadawul is the Saudi Stock Exchange, for reference. That just tells you a lot, right? The minute an IPO comes out, it just pops. So there's a whole mentality around looking forward towards the public markets because the public markets offer an sort of an out.
And what's interesting is like we're recording this, I think only a week or two after, I think it was Wise has decided to
move their listing from the
UK to the US, right? Like, which is, that was one of our success stories, if I can put it that way, right?
Yeah.
Even though Wise wasn't necessarily a UK business first and foremost, but certainly from a listing perspective. Like what drives this, do you think?
I think it's a few things, right? So one is obviously what we talked about. It's the overall infrastructure, regulatory infrastructure. It's what's set at the policy level, so on and so forth. I mean, in the US, you'll see they've had strings of sort of acts that have been passed, like the Jobs Act, that have allowed companies to, emerging companies to list and so on and so forth. India, for example, a decade ago had this rule that if you're making a loss, you can't list. And for venture-backed companies, that's like, wait, what do you mean? I need to make a profit, right? So
that may change, but we'll see. Yeah.
May change, right?
Yeah.
Saudi has something, and the UAE has something which is called the Unicorn Program, right? Which handpicks sort of venture-backed companies and in a way creates the right environment, stakeholders across all functional areas to get these businesses ready for an IPO.
Yeah.
A lot of it is introductions, treasury management, liquidity, so on and so forth, right? So what I'm trying to say is, at the policy level, work that is being done to push for a more, what's the right way? To push for a more sort of attractive like capital markets, right? I think it starts with that. And then there's a mindset thing, because what I've noticed from my time in between sort of India, Asia, US, and now the UK is a lot of times wealth creation by way of exits and IPOs and so forth, so on and so forth. Wealth creation is not looked up upon in the UK as it is in the US.
I've written it not extensively, but we have this sort of weird attitude, certainly in the UK, where we idolize inherited wealth and really, really demonize self-made wealth, right? Like it's just bizarre.
That's what I found surprising, right? And like you're saying that, and so many other of sort of my mates in the UK have said that, like they see that, like. I think that in itself is like, it's a mindset change, right? Because that has to happen, right? Whereas in the US, it's like, not even in the US, you just look outside the US, right? Because we keep comparing with the US. I say, look at the Middle East for that matter, right? I speak to founders in the UAE and Saudi. They're constantly just looking forward towards this, right? It's like this whole thing, like celebrating success, right?
And even I would go further and say, like in what I've found in the UK is, team members, employees within like venture-backed startups actually really, really deprioritize equity over cash. Right?
Yeah.
Like in the sense that if you're sitting there and you say, okay, we're going to give you, X% of equity in the business, they would rather take a pay rise than take that equity. And maybe because we haven't had that massive story that people have been able to look at, and we haven't created, the equivalent of a PayPal mafia or whatever.
Yes.
And therefore they don't have that mentality that, okay, this could lead to generational wealth for me, my family, etc. And the second thing, I think part of that rationale is in the US, of course you have blue blood families and you have a bit of kind of old wealth, but it's not old wealth in the same way that Europe has. Like, and
exactly.
I'd say it's a Europe-wide problem in that we do have this kind of, real almost monopoly on wealth being owned by, a very, very small number of very wealthy families that have been either industrialists or, frankly, have been titled wealth from, generations and hundreds of years, right?
Yeah. No, and I just say, I mean, for lack of a better phrase, it's like Europe needs a bit of that roaring 20s mentality, which was there in the US, and just to celebrate success and wealth like that. And I really, really feel Klarna and Revolut should create a situation where suddenly there is a whole cohort and a generation of operators, of employees, of stakeholders who wake up and say, you know what, this works.
Yeah.
And you need that. And if every 10 years you create a $50 billion outcome like Revolut, I mean, that's great, right?
Yeah.
But we need that. That's what it is.
But then I guess that, going back to your earlier point though, right? If these companies, the problem is the public markets are not supportive, right? So these companies end up listing in the US. They often shift headquarters, Topco, et cetera. And then a lot of the senior management who take pieces of the cap table just means that the UK, like those UK employees who may have put in the hard slog in the early years, actually then end up either leaving, not being able to realize their equity or whatever. And that flywheel then gets broken, right? Like that wealth isn't coming back into the pockets of UK or European employees.
And that's a real problem, right? That's something at Freedom as you've also been sort of hammering down upon, which is, growth stage capital primarily is from American firms. Yeah,
100%.
Right? So towards the end of the flywheel, right, you start with everything. You do it completely right, Europe. It's like you've done R&D, you got some of the best STEM graduates across the world.
Yeah, SCI, CIS, all the
everything. So you come, and it's like you got the nice regulatory sandbox for everything. Like it all works up until the growth stage. Then come in the American capital sort of basis, or even to that extent, like a sovereign capital basis, right? And you just move wealth creation either west or east.
Yeah.
Right. So that's kind of what happens. And then you're like, okay, wow, what happens now, right? And then you see even some of the most storied champions of the UK end up becoming a partner at a large accelerator in the Bay Area.
Yeah.
Right?
Yeah.
So it's gone.
Yeah. We're talking about Tom Blomfield, obviously, very specifically. But,
indeed.
Yeah. But that's a massive shame, right? And I know lots of founders that, have been successful, have had successful outcomes in the UK, and definitely not billion-dollar outcomes, but certainly, very good ones, who love the UK, love Europe, think that there is opportunity here, but will still say, I will split, like, it's almost like I'm going to
split my time.
Yeah, I'm going to describe it in a way that is probably going to cause offense to a bunch of people, but, it's okay. I'll Topco in the US because I can get the capital out there, but I'm going to have my employee base in the UK because it's cheap.
Yeah.
It's like 50% of what I'd have to pay in the US. I have a concern that UK Europe is kind of becoming the offshore, like essentially the Bangalore kind of call center of the tech ecosystem, because, like an engineer today, you can get a good engineer for £80,000, which is just like ludicrous, right? And it's like $500,000 in the US.
And imagine that's like a 404 error to an Indian, because I'm like, wait, what the hell? Like you're playing with us now, right? But it's a fact, right? I've had this conversation with like 2 Stanford graduates, 2 friends. They've moved to London in the last 2 years. They've raised their seed rounds from American funds, 3 to 4 million, and they're just extending their cost base because they have the talent here. Now, talent, there is great talent, right? Talent coming out of Oxford, UCL, Imperial.
Amazing,
the UK has every ingredient to be a world-class superpower, and you can see that the policy is headed in that direction depending on who you speak to, right? You and Hussein, a lot of you have a different opinion on that.
Sure.
But it's got everything, right? But then it's at the end of that flywheel where it just gets sort of detached and it goes. And because wealth creation does not then come back, the flywheel is just not going to work.
Yeah,
people are not seeing this.
Because essentially the flywheel is stopped, right? Mid-turn, right? And then you got to start again from the top. And look, I mean, again, we've talked on this podcast far too many times about like these problems with Europe and UK in terms of late stage capital, in terms of public markets, etc. And I think, that sentiment is very, very clear, certainly within the venture ecosystem, that something needs to change.
Yeah.
I don't think any of us have all the answers, but I think there are some obvious things that could be changed. But I think the one thing that, I hear from you and I've heard from others is exactly what you just said. We have all the ingredients. We just need to bake the cake like fully, not leave it half baked, which is what we're doing at the moment.
And celebrate wealth creation. Right?
And absolutely like champion the people that are creating. And just going back, like, okay, the flywheel we can see, but what does Europe, what does Europe have to offer? And like in terms of the broader macro context, because at the moment we've got, without getting into the politics of it, because I really don't want to get into the politics of it, right? But there's so much stuff happening globally. Like, how should European founders, UK founders be thinking about essentially taking advantage of some of those issues? And like, how do you contextualize that macro perspective?
Honestly, it's a it's a great time to be building in Europe from that sense,
Yeah.
right? Because I think there is a very small window, given what's going on in the macro, that is allowing Europe to position itself from sort of position itself from a point of strength.
Yeah.
Right. You even saw what happened with the recent meeting between the Germany and the US and so on and so forth. Given that we're in the middle of this corridor of, let's say, US Asia, US China,
Yeah.
sort of very well placed with all the right ingredients, all the sleepy capital allocators are also waking up, right? Which would mean some of the oldest institutions and family offices of Western Europe that have historically deployed in the US.
Yeah.
That's one. And then those same capital bases that were heavily investing in the US are now actually, picking up the drawing board and saying, wait, you know what? Maybe I think we need to look at other markets, right? Now, what those markets are, whether it's Europe, whether it's India, whether it's sort of emerging Asia, it really depends. But the fact is that these discussions come on the table. So it's sort of the right time to hamper on sort of key industries or where Europe's strengths sort of lie, right? It's data on the factory floor, as an example, right? Defense, right? As an example. This is sort of the perfect time to sort of have our own Palmer Lucky, right? Whatever shape or form that person takes, right? You're seeing a lot of application in infrastructure that everyone's saying, you know what, America's built GPT, let them commoditize the LLMs. That's fine, right? We'll take care of the application layer, because Europe's advantage is its data that's stored in all these legacy industries.
Yeah.
Right?
And 500 million people.
And 500 million people, right? Yeah. So I think if you play that sort of card really, really well as a founder right now, and by playing that card, I mean, really build your own distribution also as a founder, as an individual voice, and to just have a bit of that unabashed American optimism in what you do, I think you could do really well. Yeah,
I would very much agree with that sentiment. I think like the ingredients are in place. I think the problem we have in UK, Europe, etc., is like where we are almost overtaken by some of the political discourse that happens, which is actually just a massive distraction. I'm very much guilty of it myself. I mean, like, definitely there are some issues that need to be kind of resolved, but actually, if you've got your head down, you're building, you could build some incredible businesses and technology. And, again, going back to the earlier point, the ingredients are there, the talent is there, the early stage capital is there, some growth capital is there. If you're saying these sleepy allocators are waking up, then, hopefully that will help at those later stages as well. Germany, of course, has launched, what is it, $500 million? I can't remember now, but,
some number like that. Yeah. Exactly.
And others in Europe as well, right? So, and there's talk of sovereign wealth funds now, I think, in the UK, and all of this sort of stuff should help. I think one of the things that I not question, but I wonder is like how useful it is for, say, the British Business Bank, obviously, and understanding their mandate, but because they restrict where you can invest, how you can invest. Like I feel like that is a lost opportunity, because it doesn't really matter if you've got a UK fund that invests in a German business, or a US business, or a LATAM business. That cash flow on exit still comes back into the UK.
So that it's so interesting you mentioned that, and I've spoken to capital allocators in North Africa, in the Middle East, in Europe, and in the US, and this is like my single biggest sort of pet peeve. But I'm like, I understand why restrictions on deployment need to be made by public institutions, right? Sure. Initially, but in advanced ecosystems like the Europe, which I call advanced, you need to start veering away from that a little bit, even though I understand that the mandate is to achieve certain goals, and that's why you use public money to do that. But to your point, if the deployment works well and you are backing someone to do that, the money will come back to the ecosystem. Yeah. So I think that is a very, very subtle yet a very important change that needs to happen on the LP side, because that could unlock sort of limitless opportunities in that way.
Yeah, and you can, to your point, you can structure it in a way that, okay, fine, restrict it to 20% can be deployed in non-UK or whatever, right? But I mean, the point is, if the capital flows back, that's more capital to then allocate into UK businesses. And again, you produce that flywheel. And, we could have a debate around, okay, concentrated versus diverse portfolios, but one would imagine if you've got a portfolio that is purely geographically concentrated, you are losing out on alpha, right?
And that's, I think, again, a playbook from, and I hate always drawing parallels, but playbook from the Americans, right? It's like they will find alpha wherever alpha exists.
And there's a reason why they came to the UK and Europe, right?
Right.
Like they all set up offices here like 3-4 because hey, we're 30% underpriced compared to US,
They will find the alpha because they are willing to go to places, right? So that similar mentality has to come across the investors in the continent that, look, if alpha exists somewhere, let's go find it versus trying to believe in a story that alpha exists in a very small geography of XYZ part of Europe, right? I think that change is super important. I mean, you've seen funds out of Brooklyn investing globally in some of the best deals. How do they do that sitting there?
Yeah.
It's, you know what I mean? They will find the alpha. So we need a bit of that here that people are like, oh, you know what? This European fund, it's going to invest wherever.
Well, they come to Europe in August and write checks. That's what
that's when we're away, right? So then they come and write checks because we're in the beach. So it's, that's why we did an investment in Ivory Coast for that matter, right? So it's like, we're also trying to push the boundaries of the companies we see and meet at Speed Invest because we're like, we need to do this. And we're doing it with fintech because we feel fintech is something that moves really well across borders.
It's
not in every industry it works.
Yeah.
But just a small example, right? We're just one fund. We need more people to do that.
Yeah.
So.
No, look, I mean, again, this is a topic that I think we could talk about for like forever, as is always the case on this podcast. But I wanted to also pick your brain about your thoughts on early stage versus growth stage thinking, right? And we've, because of the sort of lack, for want of a better word, of growth stage investors on this podcast, we've really only had a few, right, that I would consider truly growth stage. I think we had Sapphire, we've had Dawn Capital, a couple of others, right? But early stage investors often prioritize kind of vision over numbers, right? Metrics. But you're investing at Series B and beyond where metrics like essentially are everything, right? You're moving towards the more private equity stroke public market type thinking around those businesses. So how does your thinking and diligence approach shift when you are looking at late stage versus early stage startups? And for all the founders and I guess CFOs out there, what are the metrics that you think truly matter? And you've also mentioned that your biggest returns have come from fintech. So given the kind of global economic pressures, where do you see those fintech opportunities shifting and what does it take for growth stage fintech businesses to truly stand out? But let's start with the kind of early versus late stage and what are the metrics that matter?
So at least in sort of my experience, what I've noticed with early is a framework that's worked for me pretty well, but everyone has their own framework. It's almost like, it's like 4 T's, right? Which is team, TAM, timing, and traction, right? When you take a blank piece of paper and you can just put anything across these 4 T's, it just makes a lot of sense. You're like, okay, this is great, right? I need 1 page to be able to assess this, right? And obviously you have to caveat with TAM that never be rigid on TAM because the best companies will never follow that market.
Yeah, Uber didn't have a TAM, Airbnb didn't
They'll
have a
disrupt,
TAM.
they'll create new markets, so on and so forth, right? So you're indexing on very, what I call sort of soft variables in that sense. And to develop capabilities to index on those soft variables is why I say venture should not be someone's first job. Controversial take, but we'll get into that.
We're getting into that, later.
But at the growth stage, I think growth stage, it's interesting, right? It's almost like, it's also a stage which is, I think, pretty ripe for disruption from AI, to be honest. Because you cut up diligence into 3 areas, commercial, financial, legal, right? Legal as sort of self-explanatory. Commercial and financial is where a bit of the fun happens and what sort of growth investors typically do, right?
Yeah.
So addressing financial first. Depends company to company, but realistically, when you're a Series B investor investing Series A plus, you want to start engaging with companies that are typically above the 5 million revenue threshold, right? And by revenue, I mean like revenue.
Yeah, right? Okay. So guys, remember, revenue is a financial metric that people know about. You can't like just assume that because you have a contract that's revenue, right? Please.
That just saves us time because like you have to go into the financials and the minute you see net revenue. And in fintech businesses, it's very interesting, right? Because when you take out financing costs, right, that's when the true revenue comes in, right? But it's very, very different compared to what it looks like. But so anyway, so you look at revenue, 5 million above. Then you want to see 100% plus year-over-year growth, at least. And all these metrics have to be related to what the fund size is, right? And I think that's pretty important for founders to quickly index before going into a meeting. If they're meeting a fund that is $300 million, right? And let's say, 240 million of that is investable capital, right? I've taken out 20%, which is fee so years. So from that 240 million to realistically 3x that fund, which is a classic underwriting, what does the math look like in terms of portfolio construction?
Yeah.
Founders can roughly get an idea that each deal has to be underwritten at 3 to 5x, right?
Yeah.
So you sort of back out that. You're like, okay, that's interesting. Then you can use that as a way to be like, okay, this is the valuation I want to sort of go for, right? That's level 2. And then you come down level 3, which is like, okay, if I'm pitching a 200 million valuation post money, what does that look like from a multiple perspective, right? And then you put that level 3 into a GPT and be like, hey, what is this compared to public market companies, right?
Sure.
So you could almost reverse engineer the entire VC FTD pitch,
Yeah.
financial due diligence, and go into a meeting and just say, look, these are my numbers. This is what growth looks like.
And this is how we return your fund, or
Exactly,
2
right?
to 3x. Yeah.
Because the job of an investment team member to do financial due diligence is to primarily understand that whole sort of flow, right? That does that revenue growth sustain year over year with a diverse customer base, with positive unit economics, right? With global expansion, so on and so forth. And you put sort of sensitivities to that to be like, does this case make sense for a 3 to 5x return? Put simply, that's financial due diligence, right?
And just sorry to interrupt, I guess the point there is like at growth you're looking 3 to 5x, whereas at early stage you're looking at 100x, right? Like in terms of assumptions around what that business needs to do in order to return capital, right? But you're also investing at the riskiest stage, whereas at growth you should have. Well, some of that risk has been taken off the table by then.
It's de-risked, right? Yeah, exactly. And it's so counterintuitive that sometimes I've had conversations with some excellent founders who come in to the pitch and go straight on all the metrics you want to listen to. Top line, year over year growth, net dollar retention, unit economics, LTV to CAC, NPS, everything. And you're just like, wow. It's like a wet dream for an MBA student.
Yeah.
You see that and you're like, this is great. But sometimes the founders who do that are actually the ones where there's something under the hood, right? And that's when you sort of get inside the numbers and you're like, okay.
Yeah, they're almost too bullish.
They're almost too bullish.
Like, what are they trying to hide?
So it's so difficult, right? It's like, if there's one right advice, it's almost like just in your opening calls to go with like light touch DD, right? It's like, just show a bit of the numbers, right? Don't open up the Pandora's box or whatever it is. So that's on the sort of financial side. And then sort of the last job for a growth investor in that sense, put very simply, is commercial due diligence, right? Which is customers, references, clients. Because you tell me as a company, these people are your customer, and you put a big Revolut logo there, right? But it's only
I can bring up Revolut and figure
exactly
out, like,
right. Or it's a Revolut, it's a POC, right? For all you know. So I think that's sort of validation, right? And you put all these metrics into a very concentrated 30-minute meeting or a little bit work thereafter, and you have to sort of come up with a decision, and you have to just sort of rinse and repeat that, and that same exercise sort of varies for other growth funds, but this is primarily what growth stage investing would be.
Yeah,
right?
And you and I were talking a bit earlier about some data that had come out of Carter, like this sort of Series A to Series B kind of gap. Like, it's taking 3 years plus for companies to graduate. Is that what you're seeing? Are you seeing, like, I mean, I guess it's very hard because at the end of the day, you have to deploy irrespective, right? So as long as you're finding the deals that you want to deploy into, it's fine. But what that suggests is that there are a ton of companies out there that are basically just struggling.
Very, very high quality companies are struggling to raise financing, which in class of 21 or 22
was never the case.
It was never the case, right? I mean, I'm talking about a company growing 100%, 140% year over year at the Series B stage. That took nearly 4 months to close a term sheet. Shouldn't happen because it's outside of the areas that
4 months still sounds really bloody, really very quick.
4 months to start the long form negotiations.
Okay.
4 months to set up the round, right? Okay. And these are all outside. These are all companies which are outside of the sexy area, right? These are all not AI companies per se, not AI native companies per se. And I think that's such an overlooked opportunity, right? Like just building something in your niche that customers care about. It could be anything. It could be from credit card infrastructure to waste management solutions, right? But if there's a need and the numbers work, it will get funded, but it's just taking longer, like way longer.
What advice to founders then, right? Like, should they be starting their process earlier? Should they be like, if they've got 2 years runway, and normally, we would recommend if you should be allowing 6 months for a fundraise. Should they be allowing 9 months? Should they be getting into kind of earlier conversations with VCs before they have necessarily the traction or the metric? Like, how would you, because it feels kind of existential if it's taking that long to get to a term sheet and you're burning, like, what do you do?
I think, according to me, it should be a capacity discussion, which is, look, run the business the way you are, but the minute you raise a Series A, as part of a strategic agenda, make sure you put sort of VC touch points regularly.
Yeah.
Like start early, right? Just start early.
Yeah.
It's just like VC readiness, right? Start early, know the numbers you want to hit, build up that FOMO.
Yeah.
Start to say that this is what you're going to end up doing. This is what you think. Fundraise when you don't need to raise.
Yeah.
Right?
So
The classic adage, right?
Yeah.
But the only thing I would do differently here is to really sort of double down on your distribution and your voice. Because I think in a world where everything is getting so commoditized and there's so much noise, just try to make sure your ad stands out, right?
Be authentic about what
Just
you're
be
doing,
authentic about that. I think that really, really helps. Because growth investors can only pick up certain public signals, right?
Yeah.
We'll see certain public signals, we have our own intel, and then we sort of want to engage. But the public signals are what you as a founder can control. Public signals are, it's employee growth, it's like website visitors, it's, all sort of the finer points.
PR rather than,
Exactly.
Yeah.
Exactly.
Look, I think it's, in our business, we typically kind of tap out at Series B, right? Like at Series B, one would expect to bring in a full-time CFO of some nature. But, I've seen businesses in certain sectors going into their Series B without kind of any finance people on board, although these tend to be kind of more R&D heavy businesses, I would say, right? Are you seeing kind of a shift in like, there definitely seems to be a shift from my perspective in where VCs are deploying. Like the capital seems to be flowing more into those sorts of businesses rather than kind of traditional SaaS, if I can put it that way. What are you seeing crossing your table now? Like, are you seeing the same sort of that shift from founders? Are you seeing more founders looking at more kind of deep techie type businesses as opposed to kind of more traditional
software? I think that's definitely happening. A lot of the companies that I'm seeing are companies that traditionally would take much longer to get funded.
Yeah.
But they are sort of playing to that infrastructure theme, right? Because a lot of these founders are, if they're not building AI native companies, they're going back to my initial point, it's like you own the infrastructure, you own the distribution, right? So they're going sort of, and that's ranging from telecom infra to fintech infra to industrial infra, down to the factory floor, to payments infra. So I think we're seeing a lot more of that. That's definitely there.
Yeah. I think there's no obvious answer to any of this. At the end of the day, if you're a founder, you've got to go out there and pitch your story, right? Like, and hopefully have the metrics to back that up. I always talk about it in terms of kind of narrative over numbers, but you need both to make it work, right? Like, especially
now more than ever.
Yeah.
I mean, I have seen some really, really good companies where I question, I'm like, but this has done everything in the book to get funded, but it's not been able to go past our IC. And, sometimes the reasons are very arbitrary, right? Sometimes the reason it doesn't fit venture growth. So I think this is very, very important, that I think founders should also have this conversation with their friends, their colleagues, or whoever they can tap into from their network to say, like, do I want to build a venture growth business?
Yeah.
Right? Because venture growth requires a certain growth. It requires certain sacrifices. Not getting into the 996 debate.
Please don't.
Right? And it's sort of, it's not necessarily for everyone. It shouldn't be.
No.
As a venture investor, I say it shouldn't be for everyone. Like, it's like...
Well, I mean, given that it's sort of only, 10% of businesses achieve venture scale outcomes, by definition, it's not for everyone, right? Like, or certainly not for every business. And by the way, in the UK, it's the thing that really annoys me the most, right? Like, I'm definitely a bootstrapper. I come from a family business background, like very, very Indian, East African Indian kind of mentality, which is control everything and
cash in, cash out.
Cash in, cash out, and go slow. Like do things the way that your grandfather kind of did it. And I know that I don't, and maybe it's because of my age, etc. Like I'm, getting close to 50. Like I don't want to be under that pressure. I don't think I have the temperament to build a venture-backed business. I also don't think I have the relentless kind of not only just focus but like ambition to do that, right? Like, I mean, it's just at a different place in my life. But what really gets my goat here in the UK especially is I think what happens here is a lot of founders get head faked into thinking that they've got a venture backable business because they've raised early stage financing either from angels or from early stage EIS investors who aren't necessarily true venture investors, right? Because they're incentivized by deploying, right? Their whole thing is raise money from private private capital, or private investors rather, who are tax efficient investors, deploy that cash, raise the next bit, right?
Yeah.
Like that's what SEIS investing essentially is. And what I see is a lot of founders that raise from that sort of either, private angel cohort or institutional SEIS capital. And their assumption automatically is, well, that means that we are a venture backable business. And I kind of sit there and go, you may not be, right? Like those guys often are much more kind of asset manager rather than venture investors. And I don't know what my point is. I think my point is that like founders need to understand both how venture maths works, what the outcomes that venture investors are looking for, and whether your business actually is truly a venture scale business. And reality is that, again, to your point, most businesses are not.
Yep. And I think the sad part is the venture industry will always be opaque.
Yeah.
Yeah. I've tried to push for a lot of sort of democratization of that. People have tried to do that, but it'll sort of always be opaque. So it's just like, a lot of times it's nowadays, especially even when I'm looking at so many, these AI native companies also coming up, it's really getting hard to pinpoint one particular advice that you should follow for fundraising, right?
Yeah.
I mean, the traditional model was pain, preference, and passion, right? It's sort of the 3 Ps.
Yeah.
You start a business when you feel either of these 3 Ps kick, right? You felt the pain, you experience, you have a preference, you know what I mean? So it's the 3 Ps work. Now I'm seeing sort of young founders with just unabashed confidence building AI native products with zero domain expertise.
Yeah, got it.
So it's like changed the playing field completely, right? And these companies have gone on to like have $600-700 million valuations at Series B, right? Like the legal tech companies.
Yeah.
You saw Legora just announced, for example, right? And why? Because one is, okay, fine, the founding team has focused on relentless execution. But the second thing is the capital allocators have decided, you know what? I think this is an area that could be disrupted.
Yeah.
Let's pump in a lot of money to back the winning horse here. That's legal tech AI, for example, right?
Yeah.
So it's the playing field has changed so much, right?
Yeah.
For different sectors.
And yeah, I mean, like, so this is the thing, right? At the moment, what we have is you can now get to you can get to MVP or proof of concept, like using Lovable or Firetech or Firebase, or Cursor or Replit or whatever you want to use, right? You can get to revenue with those sort of tools without having to raise a dime, right? And by the time you get to revenue, you then have optionality, right? Because you can go raise, or you can bootstrap, or you can do something different, right? You could potentially even sell at that point, right? Like someone who's interested in, just create these businesses and move forward. I think what's happening in venture is that the whole venture model is like there's a ground shift, right? Because ultimately, what happens in a market where you don't need capital to grow at the early stage, right? You can make decisions, whereas in the past you almost needed venture to scale to a certain outcome. You can now potentially get, like, maybe raise a seed round and stop there, which actually makes your job a hell of a lot harder.
I know, I was about to say, right? Like, and I've been feeling this a lot too, right? In this sort of transformation of AI that we're sort of in, pre-seed seed investing, highly attractive right now, right? And I say it as a growth investor, because for my job to exist, you need to be on the train, right? But a lot of founders are like, you know what? I just need to take this train for one stop, and I'm kind of set. And I'm seeing a lot of companies, even sort of deals we've looked at, we've tried to sort of give a term sheet out to companies that are already profitable. Yeah. So they don't need the cash, right? So then it's like, okay, the existing investors were there, they want a way out.
So then you move into secondary, right?
Exactly, right? Yeah. And I think that market will evolve quite a bit. Yeah. We're going to see sort of what I call clever ways of liquidity creation. I mean, we've at Speed Invest, we've started like a DPI team.
Oh, interesting.
Literally, we made a hire for sort of creative exit strategies, right? From a banker. And I think you're going to see more of that, right? More funds are going to be able to do that, because the traditional cycle of round A, B, C, D, E, F is just, it may not hold for every company, as it has.
I think we are entering a very, very different phase of venture. And I think what's going to happen is you're going to shake out a lot of stuff, right? There's going to be some deadwood that gets shaken out. I think allocators that are taking really bold bets, like which is why I love talking to some, early stage VCs, because they really are betting on the most batshit crazy stuff. Like, I mean, but they are really going for the moonshots, right? They're kind of like backing, if not the next Elon, certainly Elon's next business kind of thing, right?
Yeah.
And those are the sorts of businesses that do require kind of deep capital, like further down the track.
Yeah.
Whereas to my earlier point, right, like software businesses just don't need that much capital, right? Like now to scale. And we saw, okay, whatever they did, they flip-flop. Klarna, sacked half of its customer success team and then brought them back or whatever, right? But we are going to see that. Like, it was maybe the wrong moment to have done it, or they overestimated what the technology could do. But we will get closer to those sort of those events where teams can scale down quite significantly and replace humans with some sort of automation and or AI. And what does that mean? That means they become more and more capital efficient, and as they become more and more capital efficient, their optionality increases. And I wonder, we were already seeing private companies remaining private for longer and longer. I wonder whether that becomes the next playbook, right? Like, if I'm a founder and I can remain private and I can just throw off cash.
Yeah,
why
and
not?
then I also feel that there will be a whole wave of companies that will do a direct listing versus a pure IPO.
Yeah.
Right?
Yeah.
So similar to the way Palantir sort of did a direct listing, I think there's going to be a wave of companies that's going to do it. I think Stripe, a company like Stripe should pursue it.
Yeah.
Right? You don't need to raise more capital. You're completely fine. You just need to provide liquidity to your shareholders. Just go for that, right?
Yeah.
I also think secondaries will become more prominent. I also think creative structures that will allow founders to buy back institutional shareholders via financing is going to be a thing.
Interesting.
Right? So it's not coming here yet, but I think it's going to happen because
that would be crazy. Founders providing liquidity to their investors.
Exactly.
Like, that's mad.
It's a very unique vehicle. I know a few funds that are raising sort of for that, but to just clean the cap table up, just, early stage investors are happy, they get out, founders retain control back, and you go back to company building, right? Which is how it should be.
Yeah.
Again, sort of makes my job a bit redundant, right? But you have to sort of...
I hope no one from Speed Invest watches this, because they're going to be like, Varun, we need to have a chat.
But like, it's like you have to be honest about what's sort of happening, because when you sort of see all this and you look at all of this, you're like, okay, what we're seeing here is we imported a model of venture capital that worked for the US, and now we're sort of adjusting it and localizing it to how it should work for the region we're in, right? It's like what the Middle East is doing, it's what India is doing, it's what the discussions are happening in Africa, that how do you adjust this model now that you've imported from a country which was designed for something completely different?
Yeah.
Right? So
yeah, look, I mean, I think interesting times, right? Like we will see how this shakes out. I think depends on what part of the hype cycle we think we're in with AI, but I think a lot of what happens in venture and with venture will be dependent on kind of some of the outcomes of some of these massive bets that have been taken over the last few years, right? I want to move on, and you touched on this earlier, right? And we have heard it on the pod before. But you've also argued that venture capital should not be anyone's first job. So what are the kind of real world skills or experiences that you think anyone looking to get into venture should prioritize early in their careers? And what do you believe is the most misunderstood part of a career in venture capital, especially from those looking from the outside in, me included?
Yeah, I think... I mean, I'm also coming from a finance and consulting background, but like I've, done sort of strings of, give me the example of how I was a club promoter and stuff. So I try to use things like that and sort of how I influence my decision making. But the key thing, whether you're coming from finance or consulting or from tech, or you're a founder or whatever you've done before, I think it's so important that when you're coming out of uni and you're sort of in your early years, you need to throw yourself in sort of messy real world environments to be able to develop first principles thinking, right? Highly, highly important. Like that's point one, right? Second thing is sort of how do you throw yourself again in those environments to develop judgment, right? It's so underrated that when you're in those jobs and you're following sort of the grunt and you're like, why do I have to respond to an email a certain way? Why do I have to do this? What is communicate? What is stakeholder management? Why the hell do I live my life saying, please find attached? It's really annoying, right? But it makes a lot of sense, right?
Yeah.
When you look back, it's like when you look back, you're like, okay, you know what? The pain that I went through, that is the penultimate pain in the corporate ladder.
Yeah.
Everything after that becomes manageable, and you realize it's all sort of people management.
It's just learning.
It's learning, right? It's people management, stakeholder management, how you view things. So at least my philosophy in venture has been, you get 30 minutes to go into a conversation with someone as a VC, and that someone has to explain their entire life motivation and details about their baby and their vision for the future in those 30 minutes. And your job is to ingest all of that and make an assumption whether or not they should proceed to the next stage or not.
And just very quickly on that, because I think this is really interesting, like how many of those decisions do you think are made after that 30 minutes? I mean, in the sense that...
Quite a few decisions. You would be surprised. And a lot of those decisions are the first line of defense, which are the juniors in a fund. Right? So a lot of times what happens is some founders are like, I don't want to speak to an associate, I want to speak to a partner. But
they're gatekeepers.
They're the gatekeepers, right? So they're the first line of defense. And a lot of, let's say, when you're sort of raw and naive in that investing experience, everything sounds exciting because someone's pitching you something, right? It's like, oh, wow, this could be a big opportunity.
I know that feeling, yeah.
So, right? It's like, so you need to increase the surface area of your experiences to be able to understand someone else's worldview from a completely different background on what they're pitching to you and relate that to financial sense to be like, does this make sense for you to then take into your weekly meeting and say, you know what, I have a deal.
Yeah.
That skill, that whole sort of flow is just so hard. Now,
and very hard if you haven't got world experience, right? If you're a 22-year-old,
yes,
like, and going into venture, you don't have the muscle memory, I guess is what you're saying, to be able to kind of make those sort of decisions.
For 95% of the normal distribution, right? Obviously, there are people who are in the outliers, and I know some of them personally as well. I think those people somehow manage to make the hustle work, but in all of them, I've noticed one thing. It's like they recognize their own myopia.
Yeah, sure.
Right? So there's a high degree of self-awareness.
Yeah. So like, I'll give you, I mean, my example is like, I've gone to and fro in my, like over the last 10 years, you know, I've been asked, you know, are you raising a fund? Are you going to raise a fund? And
I always thought you were raising a fund.
We'll talk about that maybe another time. But no, like one of the things that I know very, very deeply about myself is I come from a background, exactly as you said, of building like businesses. I worked in manufacturing. I ran manufacturing operations. I am a financial guy from a financial background. So I look at everything through the lens of a spreadsheet and numbers, right? I know if I were to go into investing, like I don't want to invest at I mean, apart from the fact that I wouldn't be raising like a sufficient enough fund to be able to do that, but like I want to invest at pre-seed, seed, right? Like at early stage.
Yeah.
Now my problem, my myopia, exactly as you put it, is that I default to the numbers, right? It's very easy to talk yourself out of an investment decision based on the numbers. Because
always 100 reasons to talk yourself out.
100%, right? Like, and the problem is, I'm trying to figure out why I have, you know, have spent time trying to figure out how do I take myself from reasons to say no to reasons to say yes. And on the one hand, it means that I'm, you know, in the very few angel investments I've made, I am hyper selective about what I invest in. But then if you think about that from a portfolio management or portfolio allocation perspective, it means that I don't have enough diversity within the portfolio for it to make sense, right? But I'm not entirely sure if that is a trait of myself that I could, you know, maybe it makes me, you know, more likely to go into private equity style investing rather than, you know, very early stage. But I don't like private equity. Like I don't want to invest in that sort of.
It's a conundrum I've faced as well. Yeah. It's like what I call it the EQ-IQ scale, right? Okay. It's like you take a slider, you put both things to like, and you adjust.
Yeah.
What level of EQ you want to use in your investing, what level of IQ, right?
Yeah.
The more you slide on the IQ side, the more you're going into buyouts.
Yeah.
Right?
Interesting.
Because you primarily want to focus on financial engineering there.
Yeah.
From your early stages to whatever you become a partner, right?
Yeah.
But the more early you are, you kind of have to reduce the IQ scale and really understand EQ first. Because
you're gonna approach it almost with a I know nothing mindset.
Exactly. And I've noticed that some of the best early stage investors are not the ones who are lauding around their degrees and so on and so forth, right? They're the ones who just have a sort of a very contrarian view of the world. It's like, just how do they think about the world? And you speak to someone on a macro topic, you learn a lot about them and how they are as a seed investor.
Yeah.
Like they will have hot takes. And I think that's what makes that job really interesting then.
Yeah. Look, I mean, again, this is something.
You have hot takes, Aarish?
well, we're going to get to your contrarian question. My contrarian opinion is that there are no contrarian opinions. Like I think there is performative contrarianness, but no. So my hot take is that is very much that I believe Africa is the next frontier environment that will create multiple billion-dollar businesses, and I predominantly believe that, not because I'm biased, because I'm from Kenya originally, but more so because I think that there are problems that are being solved in Africa that are true problems. Like,
true problems,
true
yes.
problems, right?
Yeah,
like,
I know what you mean.
And this is it's interesting when I've spoken to people who are investing in kind of Web3 and blockchain. So Ash Aurora, for example, right? And I have consistently said I don't get Web3. Like I don't understand what use cases actually exist for Web3 that are viable and scalable and so on and so forth. And she said to me, yeah, but Aarish, have you ever tried to send money out of India, for example, right? And I'm like, well, no, I haven't. I go, well, then maybe you would understand it if you had to have done that, and you'd understand why having rails that you can send money out like frictionlessly would be a valuable use case, right? So anyway, my contrarian opinion is Africa. And look, I mean, there are lots of obvious things that sort of not quite back that up, but moving in that direction, demographically, you're going to see, I think, 50% of the world's under 25s will be in Africa by 2050 or even earlier, I think maybe. Population is massive. It is aspiring middle class. There are like all of the things, and all in the meanwhile, right? Europe, the US are kind of arguing about the most nonsensical and irrelevant crap. And I think at some point will start becoming more and more irrelevant, right? And then if you think about the other challenges that Africa has, so you have climate, you have agriculture, you have population growth, all of these things like will require solutions. The fact that, so many people are unbanked, et cetera, et cetera. Like, so I just see, so anyway, that would be my contrarian opinion, but I'm not even entirely sure how contrarian it is. But the reason I think it is contrarian maybe is because you just don't have people, you don't have that many people still willing to risk betting on bets in Africa. Obviously you have in Kenya via Speed Invest. But, I've come across, like I'm on a couple of WhatsApp groups with African investors, VCs, et cetera. And like some of the stuff I see on there is kind of crazy. It's like, we're investing, but we're looking at companies doing $1 million EBITDA with like, and I'm like, okay, well, you're not venture then. What are you? What are you?
It's a different playbook.
What is going on here? So yeah. But going back to kind of the original question is, so for a young person, you've got to develop those first principle thinking. We've had people coming on here saying actually venture should be your last job. Obviously, for many, it will be the kind of middle road, right?
Yeah.
Either they've done similar to what you've done, like a path through PwC, through JP Morgan, et cetera, right? Have honed some skills and then got into venture. What do you think is kind of ideal? How would you is it your plan? Or do you think it is on the cards that you will at some stage make partner at Speed Invest and or another fund? Or are you looking to raise your own fund in the future? Like, how should people think about that path?
Yeah, I think for me, something beyond 5 years is owning something of my own, right? Okay. Now, what shape or form that takes, there are multiple avenues, right? So it could be substantial equity in a larger platform. It could be my own business. It could be a salad chain for all we know, right?
Sure.
I'm just
laundromat,
cash
flow businesses.
It's like if I put down, and you love spreadsheets, I love spreadsheets. If I put down my life to numbers, it's like there is a certain EBITDA I want to hit. Right? It's just whatever shape or form that takes.
I showed my wife that spreadsheet. She's like, that number's too low.
There you go. Now my partner says the same thing. She's like, we need to up that. Doesn't work in Kensington, but so it's a function of that, right? Now, jobs like venture, I think it's a very privileged seat to be able to get a front row view into businesses, right? And I hate it when investors use this as a pompous act to sort of show off that they're being a fiduciary. I don't think they understand what being a fiduciary means in the first place. So it's like
some don't.
Some don't. Exactly. Exactly. That's it, right? So for me, it's like a very privileged job. You're sort of you're doing this. You do your time, invest in good companies, build companies as much as you can, let the founders do their jobs. try to champion good governance, right? And just create value to an ecosystem, right? I think it comes down to some very simple basics.
That point around governance is like so interesting to me because I come from, again, that sort of a background, right?
Yeah.
Fiduciary governance. I'm like, again, in my family business, I sit in the governance, the governance kind of body for that, right? And I come very much with that approach, but I think, 2018 to 2022, we just saw an absolute destruction of governance and fiduciary responsibilities amongst, predominantly VC investors, right? Like, but at various stages. And I think one of the problems here, and again, like, we could talk about this forever and ever, and certainly it's been a recycled topic, right? Is this whole question around like 8% of investors in Europe have been operators versus 60% in the US.
In the US, yeah.
Right? So I wonder whether part of that kind of problem is that, and maybe that is the solution that you're talking to when we talk about younger people who aspire to get into venture, is get that operating experience. Right?
Yeah.
Really understand what it means, not only to operate and to build, but okay, what are some of those governance kind of problems? Like we had Fred Destin on the podcast, as you probably know. Like he talked through the challenges at board when you have egos and you have like people who want to, who want to give an opinion, even if it isn't their sort of area of expertise or their particular domain. And I think like I know very, very clearly what I'm good at and what I'm bad at, right? Like I can't sit here and wax lyrical about product because I'm not a product guy.
But that self-awareness, you're very rare. Aarish. It's like so many people have come across in venture. It's like, just do not have that sort of level of self-awareness. And I think you should, you 100% should. Like you need to know what you don't know.
Yeah,
right?
exactly.
And sort of be open about it, right? So a lot of times I think some of my best founder calls are when I actually tell the founder, you know what, like I'm not understanding this. So I'm going to either GPT or can you tell me? Yeah. I'm like, no, before you GPT, like, let me just break it down, right? Yeah. And in fintech especially, I do this with a lot of founders, which is explain to me how does $100 move in your business?
Yeah.
Very simply.
Yeah.
And you can really start to pick out the business then, right? Yeah. So it's going back to that point around frameworks thinking, first principles, and like sort of how you come down to that. But you need to have sort of self-awareness for that.
Yeah, look, I mean, I don't think that is a problem that is unique to venture. I think self-awareness in general is so valuable. It's something you pick up as you grow, like for sure, right? Like it's I think when you're young, you're bullish, you're arrogant, et cetera, et cetera. I think as you grow, you start seeing your own faults, and you either try and fix them or you maybe go to therapy, whatever, right? But I think understanding where you have shortcomings or shortfalls actually makes you better at whatever it is you're doing, whether that's investing or not, right? Because it forces you to ask questions. And actually in venture, if you're not asking questions, then what are you doing, right? Because in theory, you are coming across businesses that are, potentially moonshots, to your point, maybe doing things that you've never seen before, haven't had an opportunity to explore before. So if you're not asking the questions like, how does that $100 flow?
That is actually a very good point you mentioned, because I also, I love saying that venture is not about picking winners. It's actually about asking the right questions.
Sure.
That's kind of the job, right?
Yeah.
And if you do that well, I mean, it's a very, very fun job. Like you could not do something better than that. Like, and that's what I feel every day. I'm like, this is a very privileged job to do. Right?
Yeah, I mean, this is why I haven't raised a fund, because I don't want it to feel like a job. I'd love to just have a ton of cash sitting behind me, and I could
that would be nice.
That would be nice, but it's not going to happen today.
Oh, that would be nice.
Sadly. All right, look, just as we kind of start wrapping up, we talked about it a little bit earlier, but what is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially, or at home?
I think it's an interesting one, but I really, really believe vulnerability is a strength.
Yeah, I do agree with that.
And especially emotional vulnerability, right? It's a thing that you do not see in a lot of people in my industry, right? But I think it's a superpower if you know how to use it well, because you forget that everything, especially now that what we're sort of entering the era of AI, everything's going to be about people. Right? And the ones who don't double down on people skills, people management, how they view humans, they're going to lose out.
Yeah, I mean, again, just going back to what we just talked about, 100% agree. I think vulnerability allows you to be authentic. And when you're authentic, it allows you to build both relationships as well as value. Like I found, in a very small way, right? Like when I'm on LinkedIn, I couldn't think of being like, I see lots of people who are very inauthentic, and it really grates. It does my head in, because I'm like, this is not you, right?
No.
And it's quite obviously not you. And actually that's a turnoff, to a lot of people. Whereas I think, if you can show, if you show your vulnerability, it means that you have built up within yourself the core belief of your own strength, that you are able to be vulnerable, and you are able to kind of share your fears and your where you lack maybe insight or knowledge or whatever, right? It goes back to something I said, and again, something that you talked about earlier. It's I always okay, how do I put this correctly? I don't think there is anything wrong with being, quote unquote, the dumbest person in the room. And what I mean by that is not because intelligently you're the dumbest person in the room, but ask the dumb questions.
Yeah.
Because I can almost guarantee that if you've got a dumb question to ask, others are thinking it, but just are worried about saying it, right?
Yeah. 100%.
And I guess, look, finally, one question that we've added to the podcast recently is, I'd love to get to to know the real you, albeit that we've just spent 50 minutes talking about what you do. What is it that moves you emotionally?
I think it's family, right?
You're the second person to have said that. Okay, yeah.
And for me, like, I sort of left. Well, I left Delhi, India, about 12 years ago. So I think your biggest sort of driving force is family, and sort of the impact you want to make, right? And whatever shape or form that takes, it sort of reflects into what sort of a human you are, the legacy you create, the life you build, the impact you have on people, and the way you make people feel. I think that's all sort of all culminates into that sort of one thing, and that's what shapes your values.
That's absolutely amazing. Varun, look, it's been absolutely incredible having you on the podcast. I think this was, it was just one of the most interesting and quite kind of, not even just raw, but like just very open conversations that we've had on here in a while. For the audience, where can they find you online? Are you on LinkedIn? Are you on Twitter? Where's the best place?
I'm on LinkedIn. I'm on Twitter. I tweet about stupid stuff from time to time.
That's all of us.
But yes, they can find me there.
Amazing. Look, Varun, thank you so much for joining me today. It's been an absolute pleasure.
Thanks, Aarish. Thank you so much.